Hi there, welcome to another super quick episode on Wealth Management Bite Size. My name is Sanana Besht and I'm a financial advisor with the leading financial institution of the country. Today we're going to talk about where should I invest. Now, investing is thought to be a very magical experience, or rather things that only few people can understand, and it is not for everybody. I can please tell you today that that is not true. Investing is very simple in its principles and its combinations, and once we are clear with what we want, it becomes easy for us to figure out how we should go and invest. While we have a lot of products in the market which are there for increasing your overall wealth, a lot of times my clients ask me, but where should I invest? Should I invest in an equity fund, or should I invest in a debt firm? What will give me better results? They always think about how I can make more money. While that's a very valid question, this confusion comes from the fact that we don't make an end decision. So that's what we're going to talk about today in this video. Now, it is a magical combination. Now, that magic is very simple when you start to understand it. So first thing you need to know is, how long can you let that money stay in the market? So if you have 2000 rupees today that you want to invest in the market, are you okay with that money being in the market for 20 years, 10 years, 5 years, or 4 years? That should be your first question to yourself. Till when can you let the money be in the market? It should not be what amount of money, but till when. Now, if you've determined that, you will also need to figure out, what are you investing for? So the amount of wealth that you're creating today, why are you creating that wealth? Are you creating it for your children's future education? Are you creating it because it is your retirement corpus? Are you creating it because of some other reason? If you have the timeline clear in your mind, it becomes so much easier to figure out the next few steps. Next question you should have in your mind would be your risk appetite. Now, over a longer period of time, even if the market is volatile, it will still manage to give you a good rate of return. If you are investing money for a shorter period of time, say for 3 years or 4 years, then maybe you should not be risking a lot of market volatility, right? You never know what will happen to the market tomorrow, and that's a fact. Market could go up, but market could come down as well. But we know that if you're looking at investing money for about 20 years, even if there are ups and downs in the market, it will still give you better returns than any other way of saving or investing your money. So your risk appetite is the next big question. Are you ready to take big risk, or are you not ready to take that big risk because your investment horizon is less? Now, if it is a short-term goal that you're looking at, then bank deposit or liquid funds would be your best bet. Or if it is a long-term goal you're looking at, then equity and stocks are your best bets. Now, what is short-term goal? Short-term goal would be anything which is less than 3 years, and long-term goal would be anything which is more than 3 years. For short-term goals, we're looking at bank deposits, something which will give you a fixed rate of return. The money is available and it can be taken out at any point of time. It could also be company deposits which have fixed rate of returns. Debt schemes are schemes which are investing mostly into government bonds, and they have a rate of return which is consistent. You know it will not be impacted by market moving up and down, and very easily you will be able to get a consistent rate of returns. That's what your short investment amount would be. That means this is a money that you lying around for a while, but you know that you might need to invest it, or you might need to utilize it for a different purpose at a later period of time, which is a near future. That's when you should be looking at short-term investments. Now, if you have amount available to you which can be utilized for long term, then go for long-term debt schemes. This means that your risk is still low, but it is money which will be invested for a longer period of time within the market. Or you could go for equity mutual funds, where the mutual funds are being invested in equity and have a good rate of return with a very balanced scheme, or a balanced risk aversions to it as well. If there are higher risk you want to look at, you can always look at stocks. But again, we are not talking about trading. We're talking about buying stocks from companies and then keeping them for a period of time, because you expect the company to grow over a period of time. So these are the tools that will be available to you if you've decided what our risk needs to be, what our time period needs to be. Other option that we have would be tax saving options. If that's the only reason you want to invest in the market, we can always go for public provident fund or equity linked savings schemes, ELSS. These would come under section 80C of our investments, and the maximum you could invest would be 1.5. We have another video which goes into detail about saving schemes. Please catch us in that video as well. Thank you so much for your time today. I hope you liked listening to us. We post videos on mutual funds, insurance, income tax, and other wealth related topics. Be sure to subscribe to us and share this video with those you care for. Also, we have other videos on investments as to why you should be investing and it is a good decision, how you can start investing, and when is the best time to invest, or when would be a good time to sell your funds. Also, we have a quick tour about what are the qualities you should be looking at when buying the first mutual funds. Thank you again.